Hey, everybody, welcome to the show. So, I think for a very long time now, decades, we as business owners have faced the same challenge. We need capital to grow, but finding that right funding option can be complicated, time consuming, and downright frustrating at times. The funding industry has been changing dramatically, but I think many of us are still navigating a process built around outdated systems, slow answers, and oftentimes limited transparency. So, our guest today has spent decades inside this industry, seeing those challenges firsthand. And instead of accepting the traditional way of doing things, he built technology designed to help us as business owners get faster answers, better guidance, and a simpler path to accessing the capital that we need to grow. Joining us today is John Dicanio, founder of Direct Merchant Funding. John, welcome to the show. How are you?
I'm doing very well. Thank you for having me today.
Yeah, very excited to have you here. So I have to ask, why build this? I mean, you've spent decades in the funding industry, but what was the moment where you realized that that more traditional way of businesses accessing capital really needed to change?
Well, I've been in this space now on more of the business funding side about 18 years. Before that was more of the mortgage side. But I just noticed just how slow traditional banking is. Every time you get a file, you have to sort of pre-underwrite the file, get all your ducks in a row so you can get it to a more traditional bank. And then I've seen, how slow the turn is, right? And when these business owners come to me, they're like, John, I have an emergency or I have an issue. I need money within, a week or two. SBA, traditional banks are taking 30, 60, 90 days. And then that's really where the alternative financing popped up. Like I said, about 18 years ago. And even back then, it was not a slow process, but a more arduous process. Because back then we were only lending based on credit cards. And the revenue based on credit cards. Obviously, our industry has evolved since then. So what I have done is sort of build a larger platform, meaning that I'm giving business owners an opportunity to look at all their funding options. So instead of walking into a well-named bank and sitting there, bringing a file probably this big of all your documents for them to sort of go over and then say, okay, leave this with us and we'll get back to you shortly, and then you don't hear from them for a while. So I sort of built a platform where a business owner could come in, put their information into our system within, sometimes as fast as 5 minutes. It could be as slow as maybe 15 minutes. We'll sort of read that documentation and let them know where they would qualify and where we should be going. And then obviously it would all be based on what their urgency is after the fact, right? If they say, well, yes, I want to go more traditional so I can get 3, 5, 30-year terms, so I have a solid interest rate with a monthly payment. But if they need money within 4 or 5 days, then I would discuss with them the alternative side. So that's what the platform is for, is to have that, that borrower or business owner come in, sort of get an idea of what their paperwork looks like and where they stand, and get an honest assessment within a 5 to 15-minute range so they know exactly where they stand and they don't waste their time. You're going to, brick and mortar banks, with their paperwork like this and saying, I need a loan, you're my banker, I need a loan. So I'm trying to save them that process and turn everything more over to the technology side.
So you've obviously been watching this evolve now for a very long time, and it sounds like through the platform, you're solving a lot of those challenges. Are there still problems that haven't been solved, in your opinion?
On the traditional side, yes. Alternative side, no, because the alternative side, it's moving at the speed of light. As fast as technology comes out, the alternative side of the business funding space has been moving with it. It's accepting everything. It's adjusting every time something new comes out. But traditional side, they're still in that slow paper chase. Individual underwriters looking at everything, putting together a full package and then getting into an underwriter. They're not adopting the technology as fast as we are. So when you go to a traditional bank, I feel that they should be adopting to some of this technology. So where they can sort of underwrite a file within, even if it's a half hour, and then have an actual human touch and go through the checkbox and make sure that technology didn't miss anything. And that's why a lot more people moving from traditional to alternative, even though the cost of money is more expensive, is just the speed to fund. It is so different than the banking, traditional banking side, is that people aren't caring about the cost of capital at this point. They just want to get that funding as fast as possible to grow their business or take care of that emergency that they have.
What do you think's making it so hard for banks to adopt the technology, as you say?
I think because it's more of a, and most of these banks are publicly traded. I think it's just more of having everybody, I want to say the higher ups, the board of directors, all coming together and saying, "Hey, this is where we need to adopt." And this is where Silicon Valley has sort of stepped in, and now these online banks are doing that more than the more traditional brick and mortar banks. So you have a lot of these banks that are popping up, out of California, that are more of an online banking company. They don't have a lot of overhead as well by having the brick and mortars and having payroll to do. They're being more adoptive, but they just don't have the lending background behind them. So they are doing the banking side of it, but not doing the lending side of it. I think that that's where it needs to start merging together, is to have that online presence and using that technology for online, for doing online banking as fast as possible, whether it's ACH or wiring or, setting up an account. These brick and mortar companies, for some reason, I feel that they're at least a year or two behind technology, even though they're always saying that the technology is doing this, technology is doing that. If that was the case, you would be seeing faster turnaround times on the underwriting. You would be seeing cheaper bank fees across the board, but that hasn't happened yet. So, and I feel that's why, most of these business owners now are migrating to the alternative side of it, where we're getting our money from either traditional banks or hedge funds, at a certain cost of money, and then relaying that back over to the business owner.
So I think one of the things you touched on is, speed. And so we know that we need access to capital quickly, but speed alone isn't always enough. So how do we
Agreed.
balance getting businesses answers faster while still helping them find the right funding solution?
So, and that's where I guess the argument is now between the alternative and the traditional, is that we're trying to show that our industry, from, like I said, when I got into it back 18 years ago, I think the industry by itself has only been funding maybe was 100 million. Now in the year 2026, I think we're going to be touching 3 trillion, right? So if you look at the growth that we've had over 18 years, I think the banks are finally starting to see this. Some of the banks are starting to come around, starting to come in and ask questions, from some of our leaders that are in our space that are actually publicly traded as well, asking them how you're doing it and trying to partner up with them to be that sort of branch inside their company to do the more alternative, but with cheaper cost of capital.
So with all of the changes, right, and all the technology, AI it's not just creeping into the space, it's already
It's
here.
it's here.
So
It's
um,
definitely here.
how do you think AI is going to have the biggest impact in financing over the next few years?
I feel it's going to take 90% of the industry, meaning that you're not going to need that broker, or you're not going to need that underwriter to sort of jump into that file and say, hey, this is what you need to do. You're going to be able to upload all your documents online, and it's going to be autonomous. I mean, it's just going to literally, based on the underwriting of the AI and how that AI learns, eventually it's going to understand how to read tax returns, it's going to understand how to read bank statements, it's going to understand, what their debt service is. Once that understands that, you're talking a matter of minutes reading financial documentation to go get a loan.
And how do you think that's going to factor in? Let's use SBA as an example, because
Right.
within SBA, and one of the larger pieces of conversation when I talk to SBA lenders is the focal point of the story. So I think you're absolutely right. I think we can teach AI to take a look at all of these documents, but then what happens to the consideration point or the human element for the story of what a business or a business owner has gone through? Because sometimes that's a really important piece and it gives context to the numbers. What do you think about that?
Of course, and that's always part of an underwriting story, and how you add the numbers up or equate the numbers of what the business is doing is what happened in the business, where are they going, what are they looking to do, and AI is built for that too. There's generative learning AI where it learns, right? So it's going to learn about certain industries, certain sectors. They're going to understand what each industry is and what their roadblocks are going to be, right, for each industry. Eventually, after you put it through 1,000, 2,000, 3,000 files, it's going to learn that. So there should be a section which I've been currently building out is like an AI caller or an AI voice caller where it's generative. It learns in the conversation. It learns, about the customer. If the customer says something, it remembers that and it goes into a knowledge base for that customer attached to whether it's an ID number or a phone number or an email. If that customer ever calls back, that knowledge base is there. So, if a customer decides not to do anything today, they call us back in 2 months. As soon as that number comes up, it picks up that knowledge base. Hey, hey Bob, how are you? I know the last time it was your 20th anniversary. How'd that go? Like it's gonna have that conversation. So if it's speaking about the business and the pitfalls that business was having, it's gonna be in there, and it should be able to deduct and maybe make a summary of the story for an underwriter to or human touch at the end of that whole AI experience.
So, after such a long time of watching businesses access capital and seeing all of the challenges, what can you share with us about what you've learned about companies that are truly ready to grow, not just access capital? Because sometimes accessing capital exposes underlying issues.
So what I've seen is that a lot of business owners think they're ready to get traditional funding. Then when it comes time to actually telling them what's wrong, they get offended because they haven't been taught the right way, right? Nobody actually sits down with a business owner and says, this is what you need to do to get approved traditionally from whether it's the bank or the SBA, right? And some of it's basic, but some of it's not, right? A lot of small business owners use their personal credit card, and they overextend themselves on personal credit cards. So when a credit gets pulled, their credit utilization is well above the 30% mark that most banks look for, and that puts them in a bad spot. Then they go back to the bank. They ask the bank, can I borrow the money to pay down my debt so I can get approved? They don't approve them. And that's where the alternative sort of steps in and says, hey, we see where you're at. We're revenue-based financing on the alternative side. Your bank statements look great. I get it. Maybe your tax returns don't look good. You're writing off most of your profits, so you don't have to pay a large tax bill at the end of the year. But traditionally, nobody tells them that they should be showing a little bit of profit at the end of the year, that their credit needs to be at a certain level with their credit utilization being at another level. So when they go and then, they wait that 30 days to finally get that decline, they get upset. So the time that we get them, they're very upset. Oh, I don't want to go through this process. It's a 30-day thing. But then we tell them that we can move this fast. They're happy, but they're sad at the same point of fact, saying that somebody should have told them this 30 days ago when they sat down with the bank or the SBA on how to set up their file to get approved. So we're sort of doing that on our end. So I do that a lot, and I know there's other companies that do the same thing as I do, is that if a guy isn't ready for, or a business owner isn't ready for traditional financing, what we do is sort of say, okay, here's the game plan. This is what we need to do. Yes, I can get you money today. Yes, it's fast funding. But what we need to do is take a portion of this money, fix your credit report. This year on your tax returns, you didn't show any profit, because you took everything out. Let's show a little bit of a profit so we can show the SBA or a bank that you're heading in the right direction. You fixed your credit. Now your tax returns are showing profit. This is where, most of my clients come back to me because I do the right thing for them, is that they're like, John, nobody will ever spend a half hour, an hour with me, because obviously time is money, to help me fix myself. Most funders, on the alternative side as well, just want to close a deal, make their commission and get the deal out the door, call somebody else to do the same thing. They're not taking the time to actually understand the client themselves and their business, so they can sort of package the deal, in the next, whether it's 2 months, 3 months, 6 months, to get them to that spot, to get them a more traditional financing. They want to just keep them in that spinning wheelhouse of the alternative finance because that's where they make the most money, and they're not helping the actual business owner move to that next level.
So if we're sitting and we're listening, we're thinking, wow, I've got some work to do on my business. And then we were to get on a phone call with you. Are you sitting there and educating each one of your borrowers as they're coming through to you and they need it? Or are you sending them out to other places, just various sources of information on the internet? Because there's so many voices out there now, so many different places that we could go. It's you end up with kind of a fragmented system if you're just going here, there, and everywhere trying to learn.
I agree. So even on the internet, there's a lot of gurus that they say that they are. Then they tell the people, this is what you should do. Hit me up, and then they charge them a fee, right? which is, I get it, for your service you want to get paid, but I try to, as I do my intake and I ask my qualifying questions about the business owner, what they're looking to do, what's the need for the capital, what's going to be the ROI on the capital, a lot of qualifying questions, so I can fully understand what they need, right? Because sometimes the need is really just speed, because if they're a wholesale and they could buy a large inventory but they only have 2 days to purchase a bulk inventory, and they're making an extra 30 cents on their money because they could buy it within 48 hours. There's not much to qualify for, but I still go into that questionnaire just because I want to understand, right? Because I might get you today, get you what you need, but you're going to have the same problem maybe in the next 30 days, 60 days. I want to make sure that I understand that, so I know how to build you up and bring you somewhere where you can get maybe a traditional line of credit, so you always have that money available to you when that emergency happens.
So, what are the most important things that you're looking at, right? If we were to come through your virtual door and apply,
Mhm.
what should we be thinking of, or in terms of metrics that we need to be focused on or paying attention to inside the business that are going to help give us the best chance?
So on the alternative side, what we look for is time in business, and then we're big on revenue. So everything to me is really bank statements. So the first two things I'm going to look at is how clean are your bank statements. How many deposits are you doing every month? What is your average daily balances, beginning balances, ending balances? If you have a lot of overdrafts or negative days, that tells me exactly what I can do with the file. And then credit's really only 10% of it, right? We only look at the credit on the back end side just to make sure there's no bankruptcies, foreclosures, judgments, or anything of that nature that would tell us he's a bad borrower. So I'm not really worried about a credit score. I'm just looking what's on the credit report, because I'll fund somebody that has a 500 credit score as the same as somebody with an 850 credit score, maybe just a different tier of a deal. So on the alternative side, those are the main things that I look at. So if you're going to go on the alternative side, you want to make sure your bank statements over the last 3 or 4 months are clean. You're leaving money in the account. You're doing a lot of deposits, and you don't have a lot of overdrafts and negative days. On the traditional side, it's a 2-year thing, meaning that your business needs to be in business for at least 2 years, showing tax returns at least a little bit of a profit on a tax return. Credit score has got to be at least 660 or 680, and you want to have at least 5 to 7 trade lines on your credit report, and your credit utilization needs to be between 25 and 30%. So if you're looking to go on the traditional side, those are the first things that I would look at traditionally. If you don't qualify that side, that's where we look at it as alternative and show you where we can sort of build you up to get you to move over into the more traditional side of the business.
I think building, you just touched on something in your last answer. You talked about, a certain number of business trade lines reporting. And I think
Yes.
this is also where it starts to get confusing for business owners, because you might have had your bank say, I'm going to go ahead and give you a credit card in the name of the business, but it's
Yes.
secured to your personal, social security number. And so what that means that I think a lot of people aren't aware of is it's not reporting on the commercial side, and it's only going to report on the personal side if you default. So if
Yes.
you think you're building business credit that way, or that's counting as a trade line, you may be wrong. How many times have you seen that been a factor where you've had a business owner say, but I am building business credit, I do have trade lines, and then when you look, you go, well, not as many as you thought.
Yeah. So I see that every day, right? Because they're getting not fake information, just not the right information on what they should be doing to build their business credit. Because the SBA does look at business credit as well as the personal credit, and it's a mix of those two scores. Banks somewhat do the same. They'll go more off of personal as long as they're banking with them. They'll look at a loan differently. But there is a lot of funders out there that look strictly at your business credit. And like you mentioned, that yes, there are business credit cards that go under your personal social security number. Only if you default, it will get reported. But there are some cards out there that actually report to the business as long as you're making the payments on time. And that's where I think the separation is between most people, because they don't get the right cards or get explained which cards you should be getting that are actually going to report to your business and not just be on your personal credit if it defaults. Because there's a lot out there, and there's a lot of, I say confusion or background noise of all these guys. And once again, gurus saying that I'll get you 0% business funding up to 200,000-300,000, and guys just jump on it because they see the 0% and it is a business credit card, but some of those do not report to your business. It just stays on personal only if you default. So you got to make sure that you're reading in between the lines lines. Make sure you're asking the right questions about that business credit card that you're taking, if it actually does report, because that's what you're really looking for. Yes, the 0% financing or 0% interest sounds amazing, and that's what gets most of these guys all their money, because these guys just come in droves for that 0%, but they're not getting the right cards, right? There's probably, I would say, maybe 100 cards out there that do this, but maybe 20 to 30 of those actually report to the business.
So, how can we be sure when we're evaluating an opportunity like that, that it is going to be good for the business, that it's going to report, so it's going to contribute to that trade line number that you're mentioning? What can we look for here?
But the key is, now in these days, research is key, right? A while ago, obviously, the internet, didn't have what we had today. So now you can find out the name of the card. You can look up the bank. You can see, if it does actually report, or if there's, some type of loophole to make them report, meaning that, there could be something in the fine print saying that if you do this, or if you get this card, which is a gold card, not the silver card, get the gold card that reports. The silver card might not report. So I just tell everybody, just make sure you're doing your own research. Don't just take it from some guy that's just giving you a call because he bought a database and he's calling you. He knows you're a business owner. Do your research, number one, on the company, and then two, on the product that he's giving you. That, to me, makes just an aware business owner, not only for the initial process, but, for future on what he's trying to do, whether it's with me or somebody else. You want to understand what kind of products that they're actually bringing you, and do your research. Google and Google the name of the company, Google the name of the credit card. That's going to tell you a lot, because, there's reviews on a lot of this stuff. Hey, I got this card. It never, went to my business credit. You're going to see those, bad comments, and you're also going to see the good stuff. And that sort of can guide you on knowing what product you should be getting into.
Should we be thinking about a mix of credit? I mean, that's something that's really important on the personal side.
Yes. A mix of credit is really where you want to be. You want to have a couple different types of credit cards. You want to have auto loans. You want to have, a mortgage maybe, that mix of credit. And they usually say between 7 and 9 on your credit report is a good mix. Anything more than that or anything less than that could hurt your credit. But usually 7 to 9 trade lines, and having a good mix of those trade lines, whether it's having, like I said, for the business, a gas card, or, something that can actually help the business. And then on the personal side, just a mix of the different type of a credit card, and having, some auto loans on there, having maybe a mortgage on there. That helps your credit go a long way. Showing that you have history. That's another big thing on your credit, is having history. You can't just have a credit card that you got approved for $10,000, 4 months ago, and think that's going to get you more, right? They want to see that history of payment, because payment history, I think, is like 20 to 25% of your credit score is payment history, on how long you've been making payments, without missing a payment, having no 30-day lates or anything on your credit report. That's a huge number on the credit reporting agencies.
Thanks, John. So, if you could leave everybody today with your most important piece of wisdom or advice, what would that be?
Don't jump at the first option. Make sure that you're looking at different options and understanding what each option is going to bring you, because I've seen, once again, a lot of business owners jump into a first option, and what we call a carrot deal is where they'll say, hey, take 10,000 now. I have you pre-approved for a line of credit, but once you get to 10,000, we're going to take back 4,000 as a fee and get you a line of credit. And a lot of people believe this because they're not understanding what it actually takes to be approved for a line of credit. So I just tell everybody to, just make sure you understand what's actually out there, what you should be qualified for. If you have a 500 credit score, don't believe somebody on the phone saying that they're going to get you a line of credit that goes out 3 to 5 years at a 5% interest rate when you have a 500 credit score. And a lot of guys, and you'd be surprised how many business owners are falling for this, through, not only MySpace, but just through the internet, is when people call up because they don't understand what they have. They don't understand where they are in credit. They don't understand where they are in their business. And they go, oh, I need $350,000. No, take $10,000 now, give you back 4,000 to get me approved. How fast can you do this? And then, oh, we get this done in a week, blah, blah, blah. And guys jump at it. So the time I get that file, not only are they, they're burnt, and it takes me time to actually, change them and show them exactly what they have to do to fix what they just got involved with, and get them out of that mess. So I would just tell everybody, make sure that you do your due diligence. Do a little bit of research. Number one, on who you're working with, and then two, on what kind of products they're actually giving you, and telling you what you exactly qualify for.
Amazing. Thanks, John. You've given us so much insight and so many great things to be thinking about. How can everybody follow you, connect to you on social, and find you on the internet?
On social media, they call me Johnny Cash Advance. So yeah, on all my social medias, it's Johnny Cash Advance. You can look for on my website is directmerchantfunding.com. I'm happy to have any type of conversations. Even if you just have a question, about your business or what you guys need, please hit me up. You can, shoot me a direct message on all the social medias, or you can hit me up through our website as well.
All right. Thanks, John, so much for joining us today. We really appreciate it. And until next time, everybody.